The world's biggest bank got hacked. Yes, that's happened. And they were trading with a USB stick. You came here for the truth, so let me unveil that for you. This happened. It actually did. But what's the real story behind here that is being ignored? We're going to break that down today. I want to talk about that hack, not hacksaw Jim Duggan, but of course, we need to understand what this all means for you. Let's begin. Here we have it. If you look at it, the world's biggest bank has to trade via USB stick after a hack. Incident caused ICBC's clients to reroute some of the Treasury trades. A true shock to banks around the world. We are going to see more hacks take place. There's no question about that. They've been more common, whether it's ransomware, whether it's DDoS, just trying to disrupt. And it's going to be more common. As we go more digital, we're going to be affected by that. The banks will be shut down. We're going to have temporary pauses. Uh-oh, I can't get my money out. Wait a minute, I'm on a CBDC, central bank digital currency. I can't tap. I've got nothing. Oh, we've got to lock it down because there's a concern of this and that. This is the danger that we've found ourselves in, and most people don't see it. But if you do, you will be able to be prepared in advance. That's what it's all about. It's self-sufficiency, not necessarily just growing a garden, but you got to be self-sufficient in different ways because different financial systems are about to pop up. What I'm going to talk about with you today is the deeper level in what this whole treasury thing is all about. Let's break it down. Here we have it. Yields on Treasury bonds rose sharply on Thursday afternoon after a particularly poor auction for 30-year bonds. The 30-year yield rose, and it was unclear whether the auction was affected by the attack on ICBC. Wait a minute. That's what they were pushing. They were saying, actually, that this hack was the disrupting factor in the Treasury market. Let me explain that a little further. So what happens here is the government, they have a bunch of debt, they package that debt up, they sell it at an auction. They say, okay, we're going to do $100 billion in debt. We're going to package that all up, and then investors come, just like an auction you would buy some art or something. They can buy that debt up. Okay. And, depending on the duration, depending on many factors, there's an interest rate associated with that. Fine. And if there aren't enough buyers, what they have to do is increase that interest rate to make it more attractive, right? That's what they do. So, for instance, they could issue $10 trillion worth if they wanted to tomorrow. Is there enough buyer? Well, they can always have an insatiable appetite from buyers if the interest rate is high enough, but they have to pay that back. And if they can't pay that back, well, then we have a problem, right? Okay, that's the long term. In the solve. If you're going to take out 10-year debt, they've got 10 years to make that back. But can they? The interest rates right now, especially, are too high. This is the concern they have. The debt isn't, we're in a circumstance where they can't pay that back. So they've gone into the circumstance where now it seems like they're already having difficulty finding enough buyers. That's a big problem because they want to issue a lot more debt. Who knows what happens down in the future? Probably the same. But as of right now, this is a problem. So if they can't, who is the buyer of last resort? That's right, the Federal Reserve. And if they do that, if they monetize the debt, that means you will experience a devaluation of your currency. You can't buy enough stuff without those same dollars. Your $100 bill, think about it. You go shopping today. A $100 bill doesn't buy what it used to. You could buy groceries for, weeks and weeks on $100, not that long ago. Even just before 2020, it seemed like that $100 would take you, far. But in a matter of 3 years, a lot has changed, right? You tell me if you disagree with me, let me know. I want to know. Is it controversial? I don't think so. I think it's pretty clear. Non-delivery of U.S. debt pledged as collateral surged on Thursday as the repercussions of a cyber attack on ICBC ripple through the market. The U.S. Treasury repo fails. The amount of U.S. debt that wasn't delivered to fulfill trade contracts rose. It was the highest since March and so on. Okay, so this was a disruption. There's no question about it. But even after it was resolved, there still was a problem in the Treasury market. Okay, and they talk about this if you're interested in knowing what this was all about. Behind the ICBC hat is a gang for hire that holds systems hostage. Lockbit is what's known as ransomware as a service group. So they're just a service. SaaS, maybe they can exit their company at some point and raise a few million if they wanted to, maybe more than that. But that's what it's all about, okay? So that's fine. That's great. But there's something else. Treasury's $24 billion 30-year bond auction goes poorly, Trader says. And this is the real circumstance. It was weaker than expected. They thought they would have a big turnout because everybody wants US debt. And that's why we need to break down the real story. There's much more to this. Yes, maybe that was a real event. Like, don't worry about the ransomware factor. Why that? Who knows what's going on behind the scenes? But what do we find out beneath that? The real story is that there's something else going on. That there is not an unlimited level of the US can't go in debt forever and have a buyer without the Federal Reserve coming in to make sure that there is always going to be, this insatiable appetite. It is not possible for the US to pay back the debt. They can't pay even the interest soon enough. This is the liquidity index. And I brought this up fairly recently, and it's just showing us that we are much less liquid. In fact, we are at the levels we saw during the financial crisis. And this basically shows us that it's not what it once was. It's not what it was in 2020 or even leading up to the 2018 and things. This is a very different world. And so it is creating a problem inside of the bond market. You could look at this on different levels. It gets very technical. Let me just break out some brief points. Coupon auction sizes are increasing, creating more supply pressure for next year. Big stuff. The further gradual increases for coupon auction sizes will likely be necessary in future quarters. If the Treasury is to keep the same pattern of increases announced in August for the next 2 quarters, auction sizes would rise to new record highs. This would lift the duration of Treasury supply substantially higher in the next year as well. That means they already had a problem. They're going to have even more of a problem. Do you see what I'm talking about here? This is wild. I know it's complicated. I know it's not too fun, but let's just be honest. Large and ongoing deficits have fed expectations of significant supply increases. A very high deficit, despite a strong economy, puts focus on government borrowing. They're spending too much money, and they do not have enough buyers. They don't have the buyers for that debt. Do you understand? It's the government spends. Let's put $1 trillion there. Let's put $1 trillion there. That's great. That's fine if you got a buyer and if you can pay it back. I guess they think that it's okay if the Federal Reserve comes in and buys it all up. But understand that if that happens, your currency is devalued. So what do we do with this info? I get it. You got to understand that you need to know, no question, this is part of a cycle. There might be a deflationary event. The bond market sparks a collapse. Suddenly we have an issue that falls down. It starts to tumble different banks and so on. Okay, we got an issue here. Red alert. The response is what? The Federal Reserve comes in and they react. And they will react more than they've ever done before. They will devalue your currency and you will have to face the repercussions of that. That means, everything is a higher price. Do you disagree with me? Please let me know. I want to know what you think. The end result is not what you've been told of the opportunity of a lifetime. The end result is that you will experience more inflation. Asset prices can rise. Or you can get a stagflationary environment. It could be a combination of many factors where, assets like real estate may, just kind of flatline for a while. Maybe they go within a channel for a while and everything's unaffordable. Nothing comes down necessarily. And it's just a sluggish economy. Certainly that could happen as well. But your currency, will buy you less. There's no question. Tomorrow, it'll buy you less than today. We know this. It is a fact. U.S. debt bill rockets past a cool $1 trillion a year. I can't believe it. The debt they got to pay $1 trillion in interest rates. $1 trillion? This is something you can't walk away from that. You can't fix that. You know what I mean? Well, what I want to tell you is, if you want the latest and greatest, what I'm getting into now is creating my own GPT. You probably heard of ChatGPT. Well, they let you create your own now. I am formulating one for my only, exclusively for my private Money GPS Finance Live group. This group is going to get access to this new GPT. And what that does is it takes current market conditions and it will be able to assess that and look at the historical examples, give you all the details, give you an output based on those conditions. What did very well last time? What are the stocks associated with that? What are the sectors associated with that? Give you reasons why. And then you could input criteria. For instance, I think the Federal Reserve is going to cut interest rates. How does that change what we can experience? And it gives you the same output, the sectors and everything that would benefit as a result of that. This will be locked to only those as part of my Money GPS Finance Live. So if you're interested in that, in addition, that's already a big offer. It's crazy, but now you're going to get even more. Okay, that's coming soon. If you're interested, link is in the description. And we have the comment of the day from Bezo. He says, I use that paycheck to paycheck article in the personal finance class that I teach. He was talking about 62% of people living paycheck to paycheck. All right. Might use this video as a follow-up. Keep doing what you do. Absolutely, I will. We need to realize that it's not going to be 62% soon. It's going to be 72. It's going to be 82. It's going to be close to 100% of people, because of the way that they are going towards it. A crisis, bond market, less liquidity. We have a problem. They react, they overreact, and we get another 2020. What inflation you experienced from 2020 up until 2023, expect at least that, at the very minimal, but potentially 2 times, 5 times greater. I'm not talking about hyperinflation. I'm talking about another dose of inflation year over year over year that we could experience as a result of what they're planning. If you want to know more about that, of course, subscribe to the channel. But if you want that close classroom, small group feel, join what I call Money GPS Finance. The link will be in the description. You'll get the live sessions. You'll get this new tool that I'm building as well. I hope to see you there. Take care.